Welcome to Smart Updates, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you are new here, do not forget to hit that subscribe button so that you never miss an update. What's something people don't know about the world's most valuable iron ore deposit, and why two global giants made opposite choices? In the world of global resources, iron ore is the backbone of modern civilization, essential for the steel that builds our cities and industries. For decades, Western mining giants like Rio Tinto have dominated this market, shaping economies and markets worldwide. Rio Tinto operates with a focus on shareholder value, risk management, and long-term profitability, weighing every project against financial and geopolitical risks. In contrast, China is a state-driven powerhouse with an insatiable appetite for raw materials, and its rise has redrawn global commodity markets. For Beijing, securing resources is about national security and industrial policy, not just profit. This strategic vision lets China pursue projects that Western firms might avoid. The Simandou iron ore deposit in Guinea brings these two worldviews into sharp focus. Rio Tinto saw insurmountable obstacles and stepped away. China saw opportunity and moved in. Their divergent paths reveal fundamental differences in risk, investment, and the future of global trade. This is more than a story about a mine, it's about the shifting balance of global economic power. We'll explore why Rio Tinto abandoned a massive African iron ore prize, and why China is all in. By contrasting their actions, we'll uncover the forces reshaping the global landscape. The Simandou mountain range in Guinea holds the world's largest undeveloped deposit of high-grade iron ore, so pure it can be fed directly into steel mills. Its discovery in the 1990s sparked hopes of transforming Guinea's fortunes and the global iron ore market. Rio Tinto secured exploration rights in 1997 and began mapping the vast deposit, envisioning a company-making project. But Simandou's promise was matched by daunting challenges. It's landlocked, requiring a 650-kilometer railway and a new port, an infrastructure mega-project. The project's history became tangled in political intrigue, shifting alliances, and allegations of corruption. Guinea's political instability led to repeated changes in mining rights and strategy, scaring off investors. Rio Tinto invested hundreds of millions, but progress was slow and costs soared. The estimated infrastructure bill ballooned to $20 billion, while political risk and fluctuating iron ore prices weighed heavily. What began as a dream project became a logistical and political nightmare. By the 2010s, Simandou was seen as a high-risk, high-cost gamble unlikely to deliver expected returns. The excitement faded, replaced by a sober realization. Simandou might never pay off for Rio Tinto. The project's fate became a symbol of both hope and frustration for Guinea. For Rio Tinto, the risks began to outweigh the rewards. For Rio Tinto, the main reason for leaving Simandou was risk. The $20 billion infrastructure cost was staggering, especially in a politically volatile country. Safer, more profitable projects in Australia offered better returns with less risk. The global iron ore market had changed. Prices fell sharply, making Simandou's economics less attractive. At lower prices, the project struggled to break even. Operational complexity, building a railway through jungle and mountains, added to the risk of delays and cost overruns. Rio Tinto's leadership, now more cautious after market downturns, saw Simandou as too risky. The company's duty to shareholders meant prioritizing projects with predictable returns. In 2016, Rio Tinto sold its stake at a loss, choosing to de-risk its portfolio. Simandou had become a liability, not an opportunity. It was a classic case of a project too big to start. Guinea's political instability was a major obstacle for Rio Tinto. Frequent government changes and coups created deep uncertainty, making long-term planning nearly impossible. Resource nationalism meant Guinea pushed for more control and benefits, clashing with Rio Tinto's commercial logic. The government insisted on a costly railway to benefit Guinea, not a cheaper route through Liberia. Corruption allegations and opaque dealings led to international investigations, raising legal and reputational risks. For Rio Tinto, strict anti-corruption laws made even the perception of impropriety dangerous. Navigating Guinea's bureaucracy drained resources and momentum from the project. The environment was unpredictable, with political relationships often trumping legal contracts. Ultimately, the political and governance challenges proved as formidable as the engineering ones. For a Western public company, Simandou was simply unworkable. While Rio Tinto saw risk, China saw strategic necessity. China is the world's largest steel producer, heavily dependent on iron ore imports from Australia and Brazil, a strategic vulnerability. Simandou offers China a chance to diversify supply and gain control over a critical resource. Chinese companies backed by the state are building the mine, railway and port, securing influence over the supply chain. For China, the project's value is measured in national security, not just profit. Simandou fits perfectly into China's Belt and Road Initiative, expanding its infrastructure and geopolitical reach in Africa. Chinese state-owned enterprises can absorb costs and operate on longer timelines than Western firms. They're not beholden to quarterly earnings, but to state strategy. If Beijing deems Simandou a priority, resources will follow. This patient, state-directed approach lets China tackle mega projects others avoid. For China, Simandou is about securing the future. China's investment in Simandou is transforming Guinea's economy. The mine, railway, and port are among Africa's largest infrastructure projects, creating thousands of jobs and injecting capital. For Guinea, the potential economic windfall is enormous. Higher GDP, more government revenue, and new opportunities. China's no-strings-attached investment appeals to African governments wary of Western conditions. This has made China Guinea's most important economic and political ally. But the partnership brings risks. The project is financed by Chinese loans, raising concerns about debt and dependency. Critics warn of debt-trap diplomacy, where Guinea could be pressured to make concessions if it struggles to repay. Local communities face both opportunity and disruption, jobs and development, but also displacement and social tension. Large-scale mining can strain services and disrupt traditional livelihoods. The challenge is ensuring benefits are shared and negative impacts minimized. The project's success will be judged by whether it delivers sustainable, inclusive development. Simandou's legacy will shape Guinea's future. Simandou presents an environmental paradox. Its high-grade ore can help steelmakers cut emissions, supporting global climate goals. But developing the mine and infrastructure threatens local biodiversity, including endangered species. Building a railway and port means clearing forests and disrupting ecosystems. For Rio Tinto, environmental risks and the potential for disaster were major deterrents. Western firms face intense scrutiny and high standards for environmental and social governance. The risk of reputational damage and legal liability was too great. China's approach to environmental standards abroad is evolving, but past projects have drawn criticism. Simandou will test China's commitment to sustainable development. The world is watching to see if environmental harm can be minimized. The project's environmental legacy will be crucial to its ultimate success. With China leading, Simandou is finally moving forward after decades of delay. A powerful consortium of Chinese state-owned enterprises and the Guinean government has broken the deadlock. Construction of the railway and port is underway, with first shipments expected soon. Simandou's development will disrupt the global iron ore market, introducing a major new supplier. China's influence over pricing and trade flows will grow, shifting the market's center of gravity. For Guinea, the project offers both promise and peril. Potential for national development, but also the risk of the resource curse. Managing the influx of wealth transparently will be key to avoiding corruption and ensuring broad-based benefits. Simandou symbolizes a new era in global resource development, led by state-backed players like China. The project's journey from Western-led uncertainty to Chinese-driven momentum is a blueprint for the future. The world's resources are now being developed under new rules. The divergent paths of Rio Tinto and China at Simandou reveal a shifting global landscape. Rio Tinto's withdrawal reflected a Western model focused on shareholder value and risk aversion. China's embrace of Simandou highlights a state-driven strategy, prioritizing resource security and long-term influence. The project will reshape global iron ore supply, giving China unprecedented market power. The old order of Western mining dominance is being challenged by new players with different goals. This shift is happening across the resource sector, turning commercial contests into geopolitical ones. Simandou marks a transition to a multipolar world of resource extraction. Its success depends on how Guinea and China manage economic, social, and environmental challenges. The project could become a model for sustainable development or a cautionary tale. In Simandou's Red Earth, the new rules of the global resource game are being written.